Hey traders, it's Christopher Mullen from FXEmpire. I want to show you some quick analysis on what to expect with gold and bonds during extreme volatility. And the history clearly shows that we need to expect a market sell-off in both gold and bonds, and we've seen that. And there's still, I think, a lot more downside potential, and it's going to catch a lot of people off guard. Now, I posted this article about a week ago, maybe even more than that, showing the volatility in the bottom spiking, and when we reach certain levels on volatility, when we get a huge spike up to this red line or beyond, this is a big spike in volatility, we see the gold market sell off. Now, naturally, gold will move up going into volatility, and then as it starts to peak out, we see a sell off. We see some pretty substantial pullbacks in gold. Now, the chart zoomed way out here, so obviously a pullback here doesn't look too big visually, but overall, percentage-wise, we're looking at some really big pullbacks in the markets, 15, 20+%. And that's happened each time going forward. And here we are again, the market's rallied up, gold rallied up into the fear, into the market starting to sell off, and now it's pulled back about 15% from the highs. This chart again, about a week and a half old. So that's what to expect going forward. I'm going to show you a chart of 2008 in a minute, but let's take a quick look at what happens to bonds during extreme volatility. Here's the exact same time frame on the charts as bonds typically rally. They'll have some big spike up each time. You can see right to the upper end of these blue bars. And again up here, bonds spike going into volatility, but then they sell off. Every time we've seen a very substantial pullback in bonds. And of course, this chart is old. Bonds have pulled back 15% off the high already, and we expect them to underperform and trade sideways or lower going forward for still, I think, several more weeks. Now let's take a look at the big picture going back in time. This is gold in 2008. You can see down at the bottom here, gold pulled back 26%. And the volatility spiked. We got into the last few stages of the bear market. Gold sold off and crashed 26% because everyone was forced liquidation between margin calls, countries liquidating some of their gold reserves in order to help fund and support their financial system. It just draws on gold and pulls price down. Same thing is going on now. We've got the first wave of this gold pulling back. It's only down about 15%. I think it's got potential to fall quite a bit further, potentially down to 1,300 and change. So there's still a lot of downside potential there. Once the panic selling comes to an end, we're going to see a big bottom in gold, and I think we'll see gold and silver and miners take off. But until then, we are still under pressure with forced liquidation. Every country is trying to support their financial systems, and they're going to have to draw from their gold reserves, a lot of them, in order to help fund that. Now let's take a look over at bonds real quick. TLT, what happened in 2008? Let's zoom in on the chart here because this is going to kind of blow a few people's minds because it's not what you think. People think, well, in a bear market, you go into bonds. And yes, it is true to some extent, but keep in mind when the first wave of fear happens in bonds, you get this first spike up to this blue line or beyond. That is when bonds really take off. That's when you see this huge move. We recently just saw a 30% move in bonds. I'm not sure what this was exactly, but probably very similar actually. And then we see bonds trade sideways for a long time. They go out of favor. Now, the reason they have a 30% plus spike is because everyone piles into them, into fear. But really, once everybody's into them, there's nowhere for them to go until the market digests and takes its time. And you don't see bonds really take off in the equities market until the very last stages of the bear market, when everybody finally throws in the towel on equities. 6, 8, 12 months later, the equities market's still making lower lows, and that's when you start to see bonds explode to the upside, and that's the next opportunity. We've played this one to the upside for a beautiful gain in the last couple of weeks. Now we're in cash. We're waiting for the next big bout, which I think is still several months away for bonds. So let's take a look at the current price action of what's going on with bonds. Here we are in terms of this rally. We have seen this beautiful 30% rally, 15+% pullback, and this is the initial wave. Everybody piled into bonds. We actually traded this on this beautiful breakout from this bull flag here, this formation that was forming. We got in, played this move to the upside, got out actually on this day here, the day before it topped. This 10% pop looked like that was it. It actually had one more 10% pop, But overall, it is now trading down, and we could see bonds fall out of favor, trade sideways for several months. The VIX may continue to spike around. Eventually, it'll start to fizzle down, and the stock market will continue to make lower lows going forward a few months. And eventually, when the stock market makes new multi-year lows months from now, that's when bonds are going to spike and take off. So here's what the equities market should look like. In a perfect world, this is what we're going to be looking for in the equities market. Let's just zoom out on the chart here and focus on the SP 500. With any luck, we are going to see the market start to stabilize down here. It's going to have some type of strong rally. Some of the the strongest rallies typically happen in a bear market. So we could see a very strong, massive rally here. Eventually the market will start to top out, put in some topping phase, start to break down, and it'll just keep picking up speed, and we go into the next major bear market leg. And when we get down to this level, maybe not so much this price level, but once we start to break this significant low down in this area, not right away, but this is when the bonds start to spike. So we're looking for money to flow back into equities. Gold and bonds are going to pull back because money's going into equities, and it's got to come out of somewhere, typically the safe havens, gold and bonds. Eventually we'll be looking for a short play somewhere over here, and we'll play the downside. And when this downside hits most of our targets, we start watching for bonds to come to life, and then we play the massive rally in bonds so we can catch the drop and we can catch the pop in bonds. So that's what we're looking for going forward. And thanks for watching, and you can visit my website at thetechnicaltraders.com. Take care.